In the world of big money, we regularly observe the major players: big pension funds and foundations, large family offices and sovereign wealth funds. Yet the sheer financial power of universities is really quite spectacular. Universities have become big business, and while tuition, housing, supplies, and the expenses of universities have become enormous, creating crippling debt for many, it may come as a shock to these indebted students just how much wealth some of these schools really have. Often endowments are as they seem: investment pools maintained to propagate education and research across generations. Yet there are some remarkable anomalies. Enormous investment funds, working as political operators in the shadows, seemingly motivated by anything but education. So let's take a look a little deeper into these enormous funds, and as their scale may astonish, perhaps these giants are not as sturdy as they seem. Let's look at the endowments, castles built on sand. The first examples of endowments are very old. In 176 AD, Roman Emperor Marcus Aurelius established academic chairs of philosophy in Athens. He set them up with funding to ensure that they would be funded in perpetuity. This is the basis of the endowment model: funding put to a particular use, and designed not to be simply spent, but to be maintained for as long as possible. Beginning in the 9th century, the Islamic world would formalize a system of permanent charitable endowments, funding institutions like mosques and madrasas. Prototypical models of endowments were beginning to exist across the world. Yet in the 15th century, the practice would be formalized in European universities. An early example would be Lady Margaret Beaufort, who would create the first endowed chairs in divinity at Oxford and Cambridge in 1502. One endowment that we are going to pay particular attention to is the Harvard University Endowment. This began in 1638, when John Harvard would leave his library and half of his estate to the newly formed Harvard College. And Harvard's greatest rival, Yale, would experience a similar story, where Elihu Yale would make a similar gift to the Collegiate School of Connecticut, which would later be renamed to Yale in 1715. Throughout the 19th and 20th centuries, particularly with the rise of major business figures during America's Gilded Age, new, large wealth would lead to enormous endowment gifts, creating the endowments of universities like Johns Hopkins and the University of Chicago, with the structure ultimately being formalized legally in the 1920s, with the definition requiring that principal must be maintained indefinitely. At this point, universities were primarily invested in hard assets and bonds, owning things like land and real estate. Yet following the First World War, John Maynard Keynes would take control of King's College Cambridge's endowment, shifting the investment strategy to include a large allocation to stocks. This would cause a major shift across endowments, changing the approach from safe and steady investments to now include riskier but potentially higher returning investments. Many other universities would follow suit, with this eventually becoming the dominant model. That is, until another leap would be made during the 1980s. David Swensen would take control of Yale's endowment. During these years, investment strategies, like what we now term private equity, were growing rapidly and generating enormous returns. In the 1980s, levered buyout, the private investment strategy employed by giants like KKR, was minting enormous fortunes. Swensen decided that Yale should have a piece of that action, allocating large chunks of the endowment's wealth to private investment strategies, as well as hedge funds. As this would catch on with more endowments, it would become known as the Yale model. Today, the largest endowments are gargantuan, with Harvard's endowment having nearly $57 billion, the University of Texas system around $45 billion, Yale around 41, and Stanford around 38. Oh, and they're tax-exempt, and able to issue tax-exempt bonds. So what we have are absolutely enormous pools of capital, acting as major financiers of private investment strategies, all while supposedly acting as the stewards of education and knowledge. Are they really education funds? Or are they vast hedge funds? Well, regardless of how one might think about them, they are enormously influential. Something which has always been quite contentious with these endowments is how they're managed, since on the one hand, donors like to think of them as pools used for education, gifts meant to be protected and serve the purpose of future students, researchers, and chairs. Yet on the other hand, they're much like hedge funds. There will always be a sort of tension between the two purposes. It needs to grow and make money, but it doesn't want to be seen as a profit-making endeavor. Let's look at the example of Harvard, an endowment that we will be paying particular attention to. Harvard Management Company is one of the most powerful active management firms in all the world. And like any investment fund, it wants returns. During the 1990s and early 2000s, it would generate just that, flying ahead of its peers. Yet for the endowment to get managers of that quality, the types who could generate those large returns, it needed to offer large incentives. In 2004, its top managers collectively made $78.4 million for themselves, with its manager Jack Mayer making $7.2 million personally. Compensation was tied to performance in excess of its benchmark. Most institutional funds have benchmarks, some underlying performance metric that it compares its performance against. Very often, these are allocation and policy benchmarks. Within each asset class, or particular investment, there will usually be a benchmark. For example, comparing a large-cap stock fund to the S&P 500, or a bond fund to the Bloomberg Aggregate. An allocation benchmark weights all of these benchmarks by the amount allocated to each asset class, and creates an aggregate return, where a policy benchmark does this based on what the investment policy says is the appropriate amount to invest in each asset. In the case of Harvard's endowment, any amount that the managers were able to return in excess of their benchmark would go toward additional compensation. On the one hand, this clearly incentivizes managers to get better returns, to align their interests with that of the fund. And with such a large pool, such attractive compensation allowed them to attract the best talent. Yet on the other hand, there's moral hazard to this, where a manager may seek to outperform in order to get personal benefit, yet going too far and taking on more risk than is acceptable for the endowment. These incentives caused an explosion in the size of Harvard's endowment, flying from $4.8 billion to $25.9 billion. The rapid growth and the large amounts paid to managers began to get the attention of donors, many who were quite suspicious. Some were worried about the moral hazard, the possibility of managers taking on excess risk. Yet among some donors, students, and certainly university administrators, there was a sort of self-righteous indignation. Nobody should be getting this rich from a university's endowment, much in the way that professors get upset with coaches for making a lot of money. Well, I'm doing the important thing. Why is this guy making more than me? Ultimately, Mayer would resign, with much of his staff going with him. And while this satisfied the discontent donors, administrators, and students, their performance suffered, for it turns out he was actually a very good manager. And what the endowment would save in future management fees, though we can't be certain with a counterfactual, looks most likely to have been offset by the opportunity costs of not having such a strong manager. Following the Great Financial Crisis, in the fiscal year of 2009, the endowment lost 27.3% and did not recover until 2015. This highlights a real problem with the Yale model. By this point, university endowments had become highly allocated to risky and illiquid investments like private equity, venture capital, and some hedge funds. We'll look further into this later in the video, but the primary glaring problems are that these investments are illiquid, very risky, and charge very high fees. Thus, a pattern began to emerge with many of the large endowments, where they would perform extraordinarily well during good times, yet come crashing down during bad. And with illiquid investments, it can take quite a while for losses to manifest, with endowments potentially sitting on unrecognized losses for many months. or in the case of more systematic mispricing in private markets, years, maybe decades. In recent years, Harvard management has been paying around $40 to $50 million to their top officials, showing that through it all, ultimately, they still think of themselves as a hedge fund. So keeping that mentality in mind, let's explore what they actually do with the money. Generally, the usage of endowment funds are broken up between two different classes: donor-restricted funds and unrestricted funds. In the case of donor-restricted funds, the donated money or assets given by the donor must be used for specific purposes. This could be something like funding a particular chair. In some universities, certain chairs are named after the donors who endow them. For a made-up example, the University of School's math department having a Mr. Donor chair of calculus. These funds may also go to faculty support, for the purchase of goods and supplies, for example a laboratory. They may go to a building or facility, or frequently to financial aid for students. Yet the other class is unrestricted funds, and these can be used by the universities for whatever purposes they feel are most fit. In the case of the Harvard endowment, about 80% of their endowment is restricted, while 20% unrestricted. Year to year, they distribute between 5 and 5.5% of their endowment's funds, and thus, one important goal of an endowment is to make sure that returns from the investments are in excess of the amount distributed. With strong performance, all of these rules in place, and so much of the fund restricted by donors, it seems like endowments like Harvard's should be sailing through as a well-oiled machine, with donors and regulators watching them, not to mention administrators and students. It's hard to imagine that they would get themselves embroiled in some sticky spots. Well, maybe it's a little easy to imagine. Back in the 1990s, Harvard's venture capital arm paid $20 million to a small energy company, Harken Energy, a company which George W. Bush had joined the board of in 1986. Harvard would contribute $64.5 million in drilling assets to the company, yet only receive 84% equity. Many began to look at this deal, seeing the amount invested, the amount of support given by the management company, and the presence of a strong political actor on the board. They would conjecture that Harvard was not simply investing in the company, but was instead giving it a bailout for political purposes in violation of their fiduciary duty as trustees. Harvard would rebuff this, saying that it was a reasonable private placement in an undervalued energy company, and that it was in line with its 5% asset allocation. Yet questions and suspicions like this would not go away, and when something quite similar would emerge in the early 2000s, but on a much grander scale, suspicions would arise again in force. In the early 2000s, Harvard students, alumni, and donors would call for the endowment to be investigated with respect to its relationships with the executives of Enron and Enron-linked hedge funds. Many analyses would conclude that at the very least, Harvard's management had had a lapse in oversight, though many continued to criticize Harvard, claiming that the endowment had operated improperly, putting its relationships and entanglements above fiduciary responsibility, and facilitating fraud. Yet, no formal investigation would demonstrate wrongdoing, and thus, as the years went on, the issue would ultimately fade away. Yet ever since, for years and years, claims and criticisms would continue to emerge that Harvard's endowment was operating as a political actor. In 2021, Harvard Management Company would announce that it would cease investments in oil and gas. At the same time, the company was beginning a larger policy of ESG investing, which, if you don't remember that because it only lasted a couple years before fading into oblivion, was investing in line with the message, leading to quite absurd situations where investments were being over-allocated to tech firms that were downstream of slavery, while under-allocating to a gas company, because gas is evil. The tech company put up a pride flag, and slavery is just a part of liberal globalism. It is what it is. All of this would raise great concerns, that the endowment with a fiduciary responsibility to do what was in the best interests of the endowment were placing political motives and image above their responsibility. Increasingly, as things became more tense, and particularly more tense on campuses, the endowments of major universities would become only more scrutinized, with, on the one hand, people looking to actions like divestment from oil and gas, or ESG investing, and saying that they were violating their fiduciary responsibility for political motivations, while on the other hand, you had people like administrators and students demanding that the endowments go in entirely different directions, calling for them to be political actors. One event where this would come to a head was following the outbreak of the conflict in Gaza. As protests would erupt on campus, students would demand that the endowment divest itself of any Israel-linked firms. Meanwhile, the donors, many of whom wealthy Jews, looked at these universities and came to believe that the schools themselves were enabling the mistreatment of Jewish students. In 2024, contributions to Harvard's endowment would drop by $150 million, a 14% drop from the prior year. It was being attacked from both sides. The students demanded that it divest from Israel, claiming that it was an enabler of violent Zionism, while its donors began pulling their money, saying that the school was abusing Jews, or at the very least, failing to safeguard the students. With the arrival of the Trump administration, this would only escalate, as it became clear to everyone that the endowments were an avenue to political ends. With more scrutiny being placed on these endowments, the primary question that has emerged is that if these endowments are going to act as political actors, not simply operating for the purposes of education and research, but making very large investment decisions, in some cases billions of dollars of investment decisions along political lines, then should they retain their tax-exempt status? The executive administration appears to be taking the side that the endowments cannot have both. They cannot both be political actors and tax-exempt. Thus, as we go forward, this political dynamic looks poised to become a bigger and bigger problem for these funds. Yet more than simply issues like these, the political dimension runs much deeper. When you have tens of billions of dollars, you are going to have power players looking at you as a source of funding. There's quite a lot of influence that you can wield if you have that much money. Many of these universities have been getting money from foreign sources. For example, in recent years it was found that Qatar gave $4.7 billion across Ivy League endowments, with China found to have given enormous amounts as well, with the total amount unknown. This has raised great concerns, as not only do these endowments wield significant influence, but the universities themselves are responsible for the education of students that are going to go on to become power players in the next generation. If you want to play the long game to influence a country, then paying the endowment of the universities where the next generations of leaders are going to come from is a pretty good move. In 2025, the executive order America First investment policy would be signed, targeting endowments that were deemed to be funding adversarial regimes, particularly China. This remains as a substantial issue, as the administration seeks to end the relationships between large American endowments and universities and foreign adversarial states. Domestically as well, concerns have increasingly been raised as to the amount of voting power that has been accumulated by funds like these. While there was already concern over the investment policies of such endowments, the investments that they do have give them significant voting power in some of America's largest companies. And as concern already exists that these endowments are political actors, that concern is magnified when they have significant voting control over major companies. And something much more difficult to observe is the relationship between these endowments and non-government organizations. In the past year particularly, the role and influence of NGOs has entered the spotlight, as it's become evident that there are large and powerful NGOs who act as significant power players in the country. While further compounding that issue is that these endowments appear to be piggy banks for the NGOs. Thus, the issue is not straightforward, as there are many different vectors for the endowments to act as political agents. And with the current conflict brewing between the administration and the universities, this goes much deeper than a disagreement over what students are being taught. Back in the 1990s, as the Soviet Union fell and the new post-Soviet nations were trying to figure out their economies and political systems without the Communist Party on top, Western capital found a fantastic vector for asserting influence. The Harvard Institute for International Development would back advisory projects in post-Soviet states, while Harvard Management Company would begin making investments, particularly participating in the loans for shares deals that were emerging at the time. Between the two entities, Harvard would yield significant political power in the post-Soviet nations, alongside international financial institutions like the World Bank, the IMF, and the BIS, as well as private capital, such as Hermitage. Harvard would become a major player in the privatization of the post-Soviet Union. Because of the sheer amount of capital that they had to deploy, their involvement with NGOs and advisory projects, their influence with international institutions, and their vast network of relationships, they used their funds to decide who became the owners of capital in the new nations. What happened during the privatization of Eastern Europe was that Western capital allocated to certain friendly individuals control over vast industries, creating oligarchs. Financiers like Harvard's endowment, as well as their development project, became one of the major players deciding who would become the oligarchy of the new nations. They backed the Washington Consensus of neoliberal economics, something which ultimately created vast monopolies at the expense of political chaos and quite dire poverty. They would as well make farmland investments, allowing them to have a seat at the table in the decision-making process for the agriculture policies in these nations. It would as well have the effect of substantial displacement, with people being forced off land. While Harvard is certainly the most extreme example of this, with some analysts going so far as to claim that Harvard has acted as a CIA cutout directly, it is not the only actor engaged in political machinations like this. In another large example, Yale has come under great criticism for its involvement in Latin American infrastructure, with large investment positions, some of them either through or with other financial companies. These positions in foreign infrastructure, as well as the financing terms employed, have created a situation where foreign countries are stuck in debt. Across much of the world, particularly the poor commodity producers, foreign financiers have come in, offered them financing during crises, and when the countries have found themselves unable to pay, their infrastructure has been taken as collateral, with this over time getting deeper to the point where foreign finance, particularly extreme at the level of institutions like the World Bank and the IMF, end up dictating the policies, the politics, and the culture of other nations. A more circuitous colonization with some degrees of removal. As so much of what has been done by these endowments is in private markets, it's quite difficult to know exactly what has happened where, what the motivations were, and how everything worked. Yet one thing that is quite evident is that these endowments are political actors, and as enormous hedge funds in their own right, they are very influential political players. They're involved in the debt traps of the global banks, the new system of colonization. They've been involved in the minting of Eastern European oligarchs. They carry political weight in the United States, and have financed NGOs to affect politics. With so much wealth and power on the line, one thing is quite evident, that these endowments cannot be ignored. As increasingly more endowments saw fantastic gains attendant with the Yale model, not only would more universities adopt the investment approach, but those who already had would take it to an extreme. Back in the 1990s, a study of the largest university endowments, those with $1 billion or greater, were found to have an asset allocation of about 60% equities and less than 10% in alternatives, like private equity and hedge funds. Yet, as of 2024, allocation to equities has dropped below 60%, with alternatives coming to encompass 45 to 60%. There are a few reasons why endowments went in this direction. Going back to the 1980s, private investment strategies like leveraged buyout were generating fabulous returns. Following the years of Paul Volcker as Fed chair, interest rates in the United States were very high, and for the next several decades, they only went down. And thus, by the time the 21st century began, and particularly following 2009, interest rates had been going straight down for a very long time and had become extremely low. Where were you going to get returns? From bonds? If you're an endowment investing for the long run, then a 1 to 2% interest rate environment isn't really going to get you all that much. Yet, if you're investing in a strategy that involves borrowing, something like private equity, then you have the possibility to get enormous levered returns with very cheap money. And so, with no good return from fixed income, and ample cheap credit, money piled in to illiquid private investments. Yet there are a few problems with this. For a start, interest rates went straight down until they didn't, as only a couple of years ago, interest rates began to rise, and rise at the most rapid pace they have ever done in the United States. Additionally, as this has become the place to be, more and more money have been chasing these deals. So is it really reasonable for these endowments to expect that this fabulous performance will continue? Will we see 80s LBO, early 2000s hedge funds, and the private equity of today? Well, one major problem that's quite glaring is the way that private investments are valued. Investors in private investment strategies don't see their returns in real time, nor do they see market values. Most private equity funds record their performance and valuations on a lagged quarterly basis. Thus, if anything were to go wrong in private markets, these endowments wouldn't see it for several months. Further, since these private companies are all unique, and there's no public market for their shares, there is an enormous amount of discretion that is left up to the managers when it comes to the valuation of their holdings. Who's really to say if a private company is worth $25 or $30 million? Every private investment fund wants to look good. So the better returns they can show their investors, the better they seem to be performing. The more likely they will get future investments, and particularly concerning, the more fees they will be able to charge. Private investment funds all claim to use very rigorous methods when it comes to valuation. A few industry standard methods are comparable transactions, looking at other transactions which occurred in private markets, those of similar companies, and attempting to make adjustments to try to find what is a reasonable approximation for their company. Public market comparables, looking at a publicly traded company, and attempting to match similarities to the companies that they're invested in, typically applying some discount for the illiquidity of the investment. Or a more fundamental bottom-up approach, attempting to project out the future cash flows of the business and discounting them to the present, much as one would with fundamental stock investing. And thus these managers claim that there are industry standards, that they follow rigorous policies, and that their valuations are accurate. But with moral hazard across the entire industry, there's no reason to believe that there couldn't be systematic mispricing across the entire market. For particularly when we come to the fee structures of these funds, we see a real risk. A quite common attribute across this entire investment category is very high fees. Traditionally, investments like these would charge 2 and 20 fees. 2% of assets under management, perhaps in the case of private equity, committed capital or invested capital, and 20% of returns, sometimes with high watermarks, and sometimes in excess of a benchmark. And while over the past decades these fees have generally come down, they've come down from an enormous place to a gigantic place, with fees like 1 1/4 and 12.5 quite common, some 1.5 and 15, and with even some as low as 1 and 10. These fees are enormous. To use an oversimplified fee structure, let's imagine a $1 million investment that charges 2 and 20 on assets under management and any returns. Let's imagine that this fund had a 10-year investment horizon, with the investor taking back all gains and principal at the end of 10 years. For the sake of simplicity, let's say that this investment grew at 15% each year. Well, without that fee, growing at 15% At the end of the investment period, the investor would have turned that $1 million into $4 million, making $3 million on the investment. Yet with the 2 and 20 fee, the actual rate of return which the investor experiences is only 12.55%, ending the investment horizon with $3.3 million. Still a quite nice return of $2.3 million, but with 700,000 fewer dollars than what would have happened without the fees. But let's look at the more mild end, a 1 and 10 fee structure. In this scenario, the investor experiences a growth rate of 13.77% annually, ending the investment with $3.6 million, $300,000 more than was experienced with the 2 and 20, but still $300,000 in fees. Yet further compounding the issue is that this is a vastly oversimplified fee structure. In reality, these funds typically have much more arcane arrangements, some basing their fees on committed capital, while others invested capital, that which has been called by the fund. Some have hurdle rates, a certain return which must be exceeded before the manager can collect incentive fees. Others have high watermark provisions, where incentive fees can be collected on the way up, but if the value of the fund drops, the incentive fees cannot continue to be collected until that previous high is passed. And more than that, there are several other fees hidden all the way in the structure. Administrative and legal fees, various transaction fees, some front-loaded fees. All these little fees add up to enormous amounts. Because these fees can become so enormous, this greatly incentivizes managers to present the best performance possible, particularly as much of those incentive fees accrue to the manager, making many very wealthy private equity managers in the prior decades. Thus, there is a deeply entrenched moral hazard and motivation to misprice investments. But how can this be done? Ultimately, at the end of the investment period, some real gain must accrue to the investors. Eventually, the fund has to pay out. Well, increasingly, we've been seeing some rather weaselly ways around this. Sometimes a fund will sell its investments to another fund of the same management company, like Private Equity Co. 7 selling a company to Private Equity Co. 8. Yet more and more often, we see them extending and pretending. The origin of this idiom comes from lending, and in its most simple form, imagine that you have made a loan to somebody. 1 month, as his payment is due, he is unable to pay the loan. Now you believe that in the future he will be able to pay it back, and if you simply wrote it off as a default, you will never get those future payments. You don't want the loan to default and collect as collateral. You would much prefer that you just tell him, it's fine, just pay it later, looking the other way and assuming it will work out. Well, that can be done on the private investment fund level. Increasingly, more and more private equity limited partnerships allow the general partners of these funds to extend the life of the fund. Very often, private equity funds exist for a lifetime of around 7 to 10 years, where the investors, the limited partners, get paid back at the end of those years. But more and more often, we have been seeing managers making use of provisions that allow them to extend this time horizon. Usually the argument is that if we just get a couple more years, we can make a fantastic deal. Your rate of return will be much higher, we just need 1 or 2 more years. And this can very well be true in many cases. Yet we have been seeing funds extending longer and longer and longer. Many have begun to wonder if in a higher interest rate environment, and with so much money chasing these investments, whether they're really the cash cow that they once were. An old argument for these funds used to be that the investors should expect a greater rate of return because the investments are illiquid, because their valuations can't be seen day to day, and because transactions can be quite difficult, sometimes taking many months or years to offload an investment, an investor should require a higher rate of return. Yet increasingly, having these lags have allowed institutional portfolios to appear more stable than they are. If you have a major market downturn, and there's a 60% chunk of your portfolio that hasn't reflected that yet, with perhaps some other mispricing going on, then you appear to be doing better than you are. Thus, we've been left in a rather troubling spot. Has the illiquidity discount been eroded away? Or worse than that, has there become a premium paid for illiquidity? With interest rates rising, managers forcing extensions on their limited partnerships, so much money running into these funds, with questions of their future growing and growing, warning signs have begun to emerge. IPOs have become less common. One phenomenal benefit of an IPO is that you get to actually see what the public market values a company at. There's quite rapid price discovery. Yet with more and more portfolio companies remaining private for longer, sometimes held within funds of the same private equity companies for decades, the true reality of the market has been looking increasingly opaque. And with fewer companies making it public, this really begs the question as to just how much of that growth is real. This has given rise to another type of strategy within the industry. Particularly in a low interest rate environment, there's an opportunity to simply use corporate restructuring to generate profits, loading a company up with debt, moving the benefits to your portfolio and your investors, and sinking the company, simply bankrupting it, getting rid of the liabilities, and walking away. As more and more of the economy has become dominated by these companies, with a Harvard Business School estimate that 20% of the US economy is controlled by private equity firms, it's quite troubling to know that this strategy of financial engineering and intentional implosion is something that more and more managers are seeking as a viable avenue. At the heart of all of this, the enormous allocations, particularly from endowments, has been a major driving force fueling it all. Yet now, we have begun to see some very large sell-offs. In the past few years, as more and more funds have been extending and pretending, and interest rate rises have eaten away at the ability for financial engineering to generate absurd profits. The vast fees, potential mispricing, and opacity of all of this has caused some concern. In just recent years, there has been a quite unprecedented rush for the exits, as more and more investments have been dumped by large endowments into the secondary markets. And what we observe in these markets is quite fascinating. We have begun to see enormous discounts from the valuations that were cited by managers. What was once held in a private equity portfolio for, say, $100 million ends up selling for 90, 80, 70, perhaps 60 or 50. Enormous discounts have been observed in the secondary markets as large endowments have begun cutting. Yet that's not to say that they're moving themselves to some sort of more reasonable position. These funds remain overloaded with these illiquid and risky, opaque investments. Certainly some managers are quite excellent businessmen, truly adding value into the economy and doing well for their investors. Yet owing to the explosion and the easy money of the prior decades, this crowded house has meant that many of the players are simply not. Many are simply financial engineers and those misreporting valuations. So as it has become increasingly incumbent on institutional funds like endowments to pick the top managers, this leaves us in a troubling situation where we have to ask, will we see more of the fluff being sold off? Perhaps one quite troubling element in all of this is just at the same time that these large sell-offs began, private equity funds began to announce that they intended products for the retail market, so that now retail investors saving for retirement could get in on the action. Now, will there be some good investments here? Perhaps. There very well could be. But when you see all of these concerns abound, and suddenly the retail investor is the new choice, well, you just have to ask, are they the designated bag holder? Usually it's the retail investor who is the one at the end when nobody else wants to buy anymore. So the endowments are in a tricky spot. They remain extremely over-allocated to these investments. Investments that are quite difficult to imagine will continue to perform as they have. And as that possibility of performance is eroding away, the incentive only grows for mispricing, focusing on quantity and fees over actual business, extending and pretending, and hoping to keep the financial engineering game going until they just can't afford the credit anymore, while being attacked on the social and political side, with more and more scrutiny being sent their way. The endowments are in a bit of a predicament, for they now have vast fortunes tied up in these funds. So what happens if there's a sell-off? What happens if something goes wrong? Well, for the endowments, who are already in a bit of a tricky spot, they are facing down a fire, the likes of which would make 2008 look quite small. Any true unwind in private equity would be catastrophic. Quite simply, with nearly 60% allocations to these investments, these endowments got greedy and let their guards down. Just how much longer can it keep going? The early universities of Europe were generally overseen by the clergy, monks, theologians, and scholars. They were the heart of learning and knowledge, developing the very notion that we have of a university, with ideas like Aristotelian logic and scholasticism, many of the great intellectual leaps coming out of these institutions. Yet in more recent centuries, they began to become the ticket to the upper class, most often the upper class attending and reinforcing their social position. But as the 20th century came, they became elite factories, the place to go if you wanted to move up in social strata. Yet, as more and more people came to see the universities as the ticket to great fortune, it came to be such that there were too many people attending universities and too few elite positions. The marketing of the ticket to the upper class simply could not come through. Tuitions ramped up and up, all while expenses like room and board ballooned with it, and young people led to believe that attending university was what they ought to do, found themselves disappointed as they would look upon not particularly remarkable incomes, yet staggering debts. Among an analysis of public universities, in 1999, weighted average tuition was $3,356. Yet for the academic year of 2023, $11,260. While for private universities, over this time period tuition jumped from $15,131 to $41,540. We have come to see so many young people arrive in universities with false promises of great incomes and success, only to find once they graduate that those promises were untrue, and now they're on the hook for, in many cases, hundreds of thousands of dollars of debt. So how did this happen? Well, a number of things happened. One, there is an artificially restricted supply of universities due to the accreditation boards, which have in effect enforced a cartel of universities protecting their status, ensuring that the incumbents remain and challengers are kept out. Additionally, more and more money has been spent on bureaucracy. There hasn't been much growth in faculty over the past few decades, but in nearly all universities across the United States and much of Europe, the administrations have exploded, in some cases multiplying by orders of magnitude. It's become such that many academics believe that universities are run for the interests of the administrators, and in many cases, that's a pretty good analysis. Additionally, as there have been so many government subsidies, particularly intended to ensure that the lending market for student debt stays afloat, this has taken pressure off universities to maintain competitiveness, allowing them all to simply exist in a state where they are that expensive and market forces are null. Yet with such staggeringly gigantic funds in some of these universities, this has led many to wonder what exactly the point even is. The wealthiest schools in the United States have some of the fewest low-income students. If the purpose of these endowments really was to get students with bright minds but the inability to pay into the schools so that they could participate, then we should expect to see the wealthier schools have even more low-income students than the less wealthy schools who are more sensitive to their cash flows. Yet we see precisely the opposite. The wealthiest schools going after the wealthiest students, paying out very little from their endowments, and instead becoming farms to get new donors to fund them, like a convoluted 4-year networking and advertisement program run for the benefit of the endowments to ensure that they get new donors. And additionally, making this quite contentious, the Ivy League universities collectively hold around $237 billion in their endowments, yet simultaneously, they receive taxpayer funding and are themselves tax-sheltered, and particularly as they're giving very little back. This makes them appear to be nothing more than tax-sheltered hedge funds, with one entity running as an investment company, another a self-perpetuating bureaucracy, and education a laughable afterthought. And alright, maybe we were naive to assume that the top schools had any interest in education, but surely they should have some interest in research. Well, these large endowments only fund around 15 to 25% of research, with the overwhelming majority relying on government grants, as well as supplemental grants from the private sector. The endowments have chosen to prioritize risky investments into things like private equity and venture capital, with seemingly quite little interest in research, which even if you assume that the university endowments are entirely self-interested and greedy, there is return from research, but they seem to prefer financial investments to the difficult slog of research. So they sit on enormous piles of wealth and require that their research be funded by grants, unwilling to foot the bill themselves. And where money does get dispensed, more and more of that has been going to administration, to the vast bureaucracies, to administrative bodies, and sprawling DEI departments. The beneficiaries are the bureaucrats, then as a distant second research, and as a naive afterthought, the students. Especially considering just how onerous student debt has become for so many people, it's not very difficult to imagine why so much scrutiny is being placed on the endowments. They behave as political actors, involved in domestic and international politics. They wield their vast fortunes to meddle in the events of nations, tax-free, all while showing very little interest in students, simply watching the debt burdens climb, and paying off vast bureaucracies that are net drains on education. Yet quite curiously, we have begun to see some endowments show some curious pivots. In just the past few months, some very large universities have announced that they will be cutting graduate programs. Now, on the surface level, one may look at this and think, they're saving the endowments at the expense of their education. And perhaps there could be a component of this, though many of the things that they are cutting were the sorts of politically motivated programs that had gained scrutiny in the first place. Programs that they know they were getting objection for. And beyond that, we're beginning to see inclinations of the bureaucracies being cut. So a question does emerge. Are some of these universities using the political pressure as a cover to gut the waste that they know they have to cut, yet that they always feared backlash from? This likely varies university to university, but with so much pressure coming from all sides, the old model simply looks untenable. So perhaps the universities are adapting, realizing that they have to go back to their core mission of education and research. And ultimately what happens will remain to be seen. But the universities know this, and the endowments know this. So as we go forward, we will see what they choose to do. But so derelict in their mission, and loaded up with extremely risky, illiquid and opaque investments, the universities have to act quick, because while they stand as vast and shining palaces, testaments to the upper class, they are built on sand. And ultimately we would be much better off if the universities were fulfilling their missions. Yet they must act quickly if they wish to avoid sinking into the sand. The clock is ticking, and we have already begun to see some universities wash out. So now the question remains, who will move quickly and who will fall?